Hello, my name is Susanti. You can call me Santi. Today I want to explain how to prepare cash flow statement. But first, what is cash flow? The statement of cash flow or the cash flow statement, as it's commonly referred to, is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. The cash flow statement, or CFS, measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligation and fund its operating expense. The cash flow statement complements the balance sheet and income statement and is a mandatory part of a company financial report since 1987. The structure of CFS or cash flow statement. The main components of the cash flow statement are: first, cash from operating activities. The second one is cash from investing activities, and the next is cash from financial activities. And the last is a fourth category. Disclosure of non-cash activities is sometimes included when prepared under the Generally Accepted Accounting Principles or GAAP. Operating activities. The operating activities on the cash flow statement include any source and uses of cash from business activities. In other words, it reflects how much cash is generated from a company, product, or service. Generally, changes made in cash, account receivable, depreciation, inventory, and account payable are reflected in cash from operation. These operating activities might include: first, receipt from sellers of goods and services; the second, interest payment; and the third, income tax payments; and the fourth, payment made to suppliers of goods and services used in production; the fifth, salary and wage payment to employees; the sixth, rent payments; and the last is any other type of operating expense. Investing activities. Investing activities include any source and uses of cash from a company investment, or purchase or sale of an asset, loans made to vendors or received from customers, or any payment related to a merger or acquisition are included in this category. In short, changes in equipment, asset, or investment relate to cash from investing. Usually, cash changes from investing are a cash out item, because cash is used to buy new equipment, building, or short-term assets such as marketable securities. However, when a company divests an asset, the transaction is considered cash in for calculating cash from investing. And the last is financial activities. Cash from financial activities include the source of cash from investors or banks, as well as the uses of cash paid to shareholders. Payment of dividend, payment for stock repurchases, and the repayment of debt principal or loans are included in this category. Changes in cash from financing are cash in when capital is raised, and they are cash out when dividends are paid. Thus, if a company issues a bond to the public, the company receives cash financing. However, When interest is paid to bondholders, the company is reducing its cash. Two methods in cash flow statement. First is direct method, and the second one is indirect method. What is the difference between the direct method and the indirect method for statement of cash flow? The main difference between the direct method and the indirect method involves the cash flow from operating activities. The first section of the statement of cash flow. There is no difference in the cash flow reported in the investing and financing activities section. Under the direct method, the cash flow from operating activities will include the amount for lines such as cash from customers and cash paid to suppliers. In contrast, the indirect method will show net income followed by adjustment needed to convert the total net income to the cash amount from operating activities. The direct method must also provide a reconciliation of net income to cash provided by operating activities. This is done automatically under the indirect method. Nearly all corporations prepare the statement of cash flow using the indirect method. And now I will explain preparation under indirect method. Operating activities. The cash flow from activities operating are derived under two stages. The first is calculating the operating profit before changes in working capital. And the second one, the effect of changes in working capital. And this illustration of indirect method. Net profit before tax and extraordinary items. Cash flow from operating activities is add non-cash or non-operating items which have already been debited to profit and loss account like first is depreciation, amortization of intangible asset, loss on the sale of fixed asset, loss on sale of long-term investment, provision for tax, dividend paid, and the second is less non-cash and non-operating items which have already been credited to profit and loss account like profit on sale of fixed asset, profit on sale of long-term investment, operating profit before working capital changes. Changes in working capital is add increase in current liabilities, decrease in current asset less increase in current asset, decrease in current liabilities, net increase or decrease in working capital, cash generated from operation, and less income tax paid, cash flow from before extraordinary items, and adjusted extraordinary items. And the second is preparation under direct method. The fundamental of preparation of cash flow statement under direct method is more or less same in indirect method with only a few exceptions in terms of its presentation. And here is cash flow from operating activities. Add operating cash received, cash sales, cash received from customer, trading commission received, royalty received, and less operating cash payment, cash purchase, cash paid to suppliers, cash paid for business expense, cash generated from operation, and less income tax paid. Cash flow before extraordinary items is adjusted extraordinary items, net cash flow from operating activities, cash flow from investing activities, cash flow from financial activities, net increase in cash and cash equivalent, and cash equivalent at the beginning of the period, cash and cash equivalent at the end of the period. So that's all I can explain to you how to prepare cash flow statement. Thank you for attention. Bye.